Hi, I am Cleon from ClearTax. In this video, I will tell you about the 5 tips to invest in mutual funds for good returns. Mutual funds pool money from several investors to purchase securities. It puts your money in a portfolio of assets with a defined investment objective. You may take a look at 5 tips to invest in mutual funds for good returns. Understand different types of mutual fund schemes. Mutual funds may invest in equity and equity-related instruments, fixed income securities, or a mix of both. You may find several types of equity mutual funds, such as sector funds, index funds, or tax-saving funds. Debt funds may invest in money market instruments, government securities, and corporate bonds. Balance funds divide your investment between equity and fixed income securities. You may consider picking mutual fund schemes that match your investment objectives and risk tolerance. You could study the mutual fund schemes and the investment style of the fund manager. It helps you understand if the fund may achieve financial goals. Diversify your portfolio. You may find the return for mutual funds differ as they put your money in different asset classes and fund categories. For example, gold as an asset class has a negative correlation with stocks. You may find gold prices rising, stock markets crash. You could diversify your portfolio with gold funds, fixed income investments to protect it from the volatility of the stock market. It would be wise for you to diversify your portfolio across asset classes and fund houses to achieve an optimum risk-adjusted return. Invest in mutual funds through the SIP route. You may consider investing in equity funds through systematic investment plan or the SIP. It is a method of staggering investment in the mutual fund scheme over some time. You could invest as low as Rs 500 per installment in the mutual fund scheme of your choice. You could invest in the equity fund through the SIP to get the benefit of rupee cost averaging. It helps you buy more units of the fund when the stock markets are low and lesser units when they are high. It helps you average the investment cost and avoid timing the market. Opt for direct plans over regular plans. You could invest in direct plans of the mutual fund schemes as compared to regular plans. You could invest directly with the asset management company through the direct plan. It has a lower expense ratio as compared to the regular plan, as the fund house doesn't incur distribution expenses. The lower expense ratio of the direct fund translates to a higher return over the long run. Review your mutual fund portfolio. You may consider reviewing the performance of your mutual fund at regular intervals of time. You could compare the return of the mutual fund schemes with different market conditions against a benchmark and peer funds. Replace mutual funds that consistently underperform the benchmark for a longer period of time. Check the track record of the fund house, the expense ratio of the scheme, and the investment style of the fund manager before selecting the mutual fund. You may also consider the tax implications of your investment. Thanks for watching.